Hello, everybody. Fasten your seatbelts. We're going to talk about derivatives. So I think the pace is supposed to accelerate. It's the most fast-moving and, by definition, volatile part of the instrument range of crypto for the markets. And just a few preliminary comments. I mean, derivatives have had a bad name. Warren Buffett said it's the instrument of mass destruction 15 years ago. On the other hand, also it's been sometimes pointed to derivative that they enable some elements of the great financial crisis. On the other hand, it's been a phenomenal success in all other asset classes, and they're prevalent everywhere. Every bank, every financial institution has a lot of derivative on their books. So what we're going to examine today is how the gap for that particular instrument and sector in the crypto market, and what's the state of affairs, and how what's the path, the journey ahead of us for derivatives in crypto and institutional adoption. So we have a very prestigious panel here of practitioners and experts, and I'm going to ask them to introduce themselves.
Sure. My name is Nathan Cox. I'm the Chief Investment Officer at 2Prime. We focus on derivative strategies on Bitcoin and Ethereum, primarily focused on generating yield or alpha for clients in kind, so Bitcoin on Bitcoin and ETH on ETH yield, and also do some dated and perpetual futures trading, all quantitative and systematic.
Hi, my name is Alissa Ostrove. I'm the Chief Operating Officer of DS3 Crypto. We're a strategic advisory with roots in distressed assets, where we worked historically as a broker and now increasingly on a proprietary basis. This goes hand in hand with our advisory arm, where we work with pretty much every segment within the derivatives value chain, from large traditional hedge funds who are just stepping their feet into the market, through to crypto-native hedge funds, exchanges, and increasingly seeing a lot of engagement across derivatives markets.
I'm Shannon Kurtas. I'm from Kraken. I'm co-general manager of their Kraken Pro and Exchange business lines. Hopefully you folks have heard of us. We've been around since about 2011. We're a major global cryptocurrency exchange, one of the most liquid places to trade across spot, margin, and derivatives, which is a huge focus for us. We have Crypto Facilities Limited based in the UK, which is the UK's first regulated crypto MTF. We now have a regulated exchange and broker in Bermuda. And we are also announcing later today our acquisition of a EU MiFID firm.
Great, thanks. So on my side, I'm an ex-commodity hedge fund manager, and 5 years ago we started crypto, and we have a couple of strategies, one long short and one yield seeking on liquid crypto algorithmic trading. So with no further ado, as I just alluded to, in traditional market, equities and commodities, derivatives are sometimes 10x, 20x the size of the cash market. I think we're far from that in crypto. So the question, maybe I'll start with Shannon. How do you see derivatives driving the growth of the entire complex? And what have been the markers recently of activity?
So you're right. I think we are a bit far from that in crypto. We are growing at a rapid pace, and we don't think it's going to develop any differently from traditional markets, where derivatives is a multiple of cash markets in terms of volume and liquidity. It's a fundamental building block for risk transfer, speculation, capital efficiency, and more advanced or complicated products like structured products and exchange-traded products that hinge upon having a liquid futures and options market underlying them. We've kind of seen that in recent, let's say 6 months, where the CME, for instance, has surpassed Binance, Bybit, and the crypto-native exchanges in terms of open interest and liquidity. Another recent point to make is the launch of the weekly futures on CME, and now options and futures on the ETFs that have been launched a year ago. And so, these are all kind of building blocks that are mirroring what we see in traditional markets, and we're not surprised by that.
Lisa, any other thoughts?
Yeah, I think if you actually look at the data over the last couple of months, interestingly, the market share of spot has been increasing compared to derivatives market share. And I think that's largely due to new retail entrants that are just coming into crypto. And we continue to see this trajectory now where they eventually become more sophisticated in their trading, look for ways to hedge risk, and ultimately move into derivatives and other types of more complex products. Right now, there's a lot of focus, particularly on the exchange side, to try to target these traders. They're calling the prosumer segment, the sort of professional retail segment, and looking at new offerings and products to ultimately bring them into derivatives. But it involves a lot of education and UI to actually make that experience clear for them.
Yeah, I would just add, we've seen a lot of the institutional adoption come through the derivatives market, specifically for things like the basis trade. It's something that hedge funds are widely familiar with, but also it drives things like spot adoption. And I think looking forward, the thing we look for is the use of institutional options on things like the ETFs on IBIT as a way to create new, more structured products or hedged products, especially because the feature of crypto, which is the volatility of crypto, is also very much a bug for traditional investors. And so being able to manage exposure, manage delta, manage volatility is all something that we see as a driver in the institutional space, because they can finally do things like hedged equity, where they have certain defined risk metrics that really allowed for wide-scale institutional adoption.
Right. So I mean, it seems to me that a lot of the so-called derivative use case so far has been leverage bets on perps, right? Probably through not necessarily institutional type of money. And we've seen that overnight, actually. Apparently, there have been $2 billion of liquidation on that type of derivative, effectively. So the question really is, how do we see the product development of derivatives to map the actual products more to the institutional adopters, as opposed to the intraday or weekly punters? How do we see the product range developing for derivatives?
Sure. I mean, I think in line with that, crypto comes from a community of speculators, and so the first use case for derivatives has probably been to add additional exposure, multiplying your upside leverage to have these sort of phenomenal gains. But more and more as institutions come into the space, what you'll see is ways to actually reduce delta exposure, offer it to retail investors who don't need 100% or 50x leverage or whatever they offer on places like Binance, but rather give institutions a way to create structures that have limited downside. So I look at things like hedged equity on SPX, where you have a put spread with an upside call, and it creates a max drawdown of, say, 10%, but then also gives you the upside exposure to something like Bitcoin. I think that's a very sellable product for institutions, and that would just be one example of some of the new products I expect to be created over the next year.
Yeah, I definitely think you're seeing the trajectory in crypto as followed in traditional markets. Obviously, BitMEX, brought derivatives to the fray in 2016, and you have this real split between the crypto natives and the traditional players. Following BitMEX, you had CME, CBOE come in, and then increasingly centralized spot exchanges moving into derivatives offerings. You see that now with Coinbase and their new derivatives arm, and firms with existing derivatives offerings or perp futures offerings now wanting to move into options. So it is a evolution that I think will continue, and it's important to remember it's still very young in its infancy, while it feels like it is moving quickly for us. I definitely agree. I think structured products are a great entry point into the market. As touched on earlier with the retail segment, we've seen this. OKX has launched this really effectively through their shark fin products, basically packaging up a structured product with a very clean UI where traders can control for risk and manage their downside and actually trade structured products effectively without maybe realizing it's a structured product that they're trading. And as touched on earlier, I think with IBIT, now IBIT options, we're getting a lot more interest from the traditional side to move into these markets. Though I think there's still some reluctance to touch crypto exchanges directly. So it'll be interesting to see from the larger funds where that movement goes, and maybe we'll touch on, some of the challenges there further in the discussion.
Yeah, I think maybe two other interesting cases will be smart beta products. So, everyone's aware of the major ETFs. I look at an ETF, screener maybe once every couple weeks and have lost track of the number of ETFs there are now. Increasingly, people can buy, crypto on their, the Revolut app or other fintech apps. And so the question will be, what is the USP for these different instruments and different ways of trading and getting that delta one exposure? One case will be these smart beta products that bake in either a short implied fall strategy or staking strategies to basically give you the Bitcoin exposure plus X% alpha on top of that. Another one that we're seeing more on OTC rather than exchange-traded instruments so far is packaging up kind of esoteric crypto-specific risk and factors like the perpetual funding rates that exist because of these crypto-native exchanges that are not cleared. And they have this funding rate mechanism that people exchange between the longs and the shorts. That can be quite profitable. Let's say it's currently running about 10% per year. And other things like miners looking to hedge particular risks like difficulty that is quite otherwise impossible or difficult to hedge effectively in a cost-efficient manner.
So what do we think could be the impact on the actual market metrics of this new kind of entry of structured product development? And effectively, for anybody of you who's familiar with fixed income, we know that PIMCO Big Growth was a huge seller of volatility on the bond portfolio. And the question I have is that, do we believe that the entrance of structured product in crypto, because it brings volatility sellers, what's going to be the impact on the crypto as we know it?
I mean, I would speculate that volatility will ultimately be dampened as more professional or institutional players enter the market. I think this is the, history has sort of shown that as markets become more sophisticated and more liquid, you tend to see lower volatility over time. I can speak only for myself. When we started in the derivative space, I think the annualized vol on Bitcoin was around 120. And now it's somewhere around a 55. Similarly, ETH, had upwards of a 200 vol, and now it's somewhere around a 70. I would expect, and you can even see this now when U.S. markets open, you actually see a proliferation of volatility selling during U.S. hours because you have large option players that are actually coming in and dampening that volatility. So my expectation as things get more sophisticated, you'll see better liquidity, but also lower volatility.
Yeah, I'll definitely echo that as well. I think we're seeing that even today with, where the markets are. Vol down, obviously, altcoins down tremendously. I think the structured product offerings, it'll be interesting to see really what segments they're catering to and who they're really trying to bring into the fray. And again, I think continuing the split between retail traders becoming more sophisticated and those with sophisticated trading strategies looking for a way to effectively hedge risk.
Yeah, nothing much to add, but I would say, we'll see the use of options to sell vol for these like regulated smart beta products, as well as things we're seeing recently on DeFi, where people are able to do this more directly in a kind of programmatic fashion. And yeah, like yesterday was a great case in point in terms of the effect on realized volatility. So
last question before we move on to maybe some of the pain points for growth and infrastructure. Basis rate, the yield and basis rates. I mean, that it's been pretty nice trade for the last few months. Do we think it's a structural trade, or do you think it's related to the temporary supply-demand mismatches in the crypto market? What's your view going forward in the outlook for the basis trade?
This is bread and butter trade for relative value prop firms and hedge funds in traditional markets and crypto. It kind of arises due to market fragmentation around who can touch cash, who can touch derivatives, how efficient the actual movement of funds is, and there's an element of course, credit risk involved as well. There's also basis between ETFs and the underlying market and futures, and so in the U.S., for instance, you get these kind of reports on the largest holders of the ETFs now that they're launched, and Millennium, Tudor, and one other fund I'm forgetting at the moment. They were listed as having positions of 500 million to $1 billion in some of the ETFs because they're trading the ETFs versus futures and ETFs versus spot. So yeah, I anticipate that continuing.
Yeah, it's a big question. How much of the ETF inflows are hedged through a future or perpetual, and how much is genuine long exposure, right? That is something that could change the balance sheet of crypto. And I think it's fair to say there's quite a few of those inflows that are immediately sold using another instrument to achieve a yield as opposed to a directional play.
Yeah, I'll just say that it's probably inevitable that the basis trade continues to compress over time. It's a function of volatility, but also a function of how many people are willing to speculate with futures or perps long. And in the community of crypto, where so many people were using futures as a way to speculate long, they're now coming into direct sort of conflict with these institutional players that ultimately will surmount any amount of volume that you could use to speculate long. So, I mean, I remember in 21, the basis was as high as like 41% or something like that. I think in December, we saw it around 16 for dated futures, and after today, it's probably around a 9 or a 10. But I suspect that it's only going to compress more and more until it reaches some sort of equilibrium with the borrow rate on Bitcoin.
Right, so we spoke about all the good stuff, right? How we can make money doing basis trades, option trades, structured products, perps. Now the pain point question, right? What does it take? What are the issues to scale derivatives? Why is the market so disjointed between venues, and why is regulation not so harmonized? So what are your views on what needs to be solved to scale that? Alissa, maybe you can give us your views on that.
Yeah, happy to start here. I think, I hate to be harping on FTX 2+ years later, but I think it really was a turning point for the industry in terms of how folks are thinking about collateral management. Where is your collateral sitting? Is it sitting on exchange? I think pre-FTX, you had a lot less interest in the off-exchange settlement piece, tri-party agreements. That has very much shifted, and I think the comfort level for institutions in terms of making sure their collateral is being effectively managed is definitely paramount. I think other considerations on capital efficiency as well and how to fund margin. I think we're still young in seeing really effective cross-margining and the ability to fund margin across different types of assets. Obviously now we have BlackRock pushing tokenized money market funds as collateral and trying to bring this into centralized exchanges. So it'll be interesting to see how that develops and plays out and matures the market going forward.
Yeah, I agree. I think the market's in kind of two segments at the moment. One, you have the regulated, centrally cleared venues, CME, the most obvious one, but also Eurex has had futures and options for a couple of years now. Then you have the crypto native, either non-clear or the combination of clearinghouse and exchange, where it's kind of two different markets in a sense. And the latter has caused things like covers Clearloop, Fireblocks, off-exchange settlement network, and all these different tools for basically mitigating counterparty and credit risk come to the fore. And yeah, to Alissa's point, the capital efficiency is not there with respect to the collateral types you can post, how quickly you can transfer them back and forth. There are some prime brokers now that are kind of doing this, to some extent, and offering you margin across the CME and places like Deribit and Kraken, but not in any kind of meaningful scale yet.
Yeah, I mean, I can only speak, echo the sentiment here, which is it's cross-collateral and margin usage, which is virtually impossible to solve if you're a crypto-native firm. I think also just how it settles for some, especially crypto-native transactions on Deribit, as an example, everything settles in Bitcoin and Ethereum. If you want to trade in CME, you're obviously transferring and settling in dollars. And there's a very different desire for a lot of crypto native, either OGs or institutions, Bitcoin miners. These generally do not want to denominate in dollars, or they don't want to give up their Bitcoin. So the ability at some point to use, I'll say, Bitcoin as collateral in these centralized exchanges and on qualified custodians would be, one of the bridges ultimately that we have to cross.
So in terms of venues, I mean, I think it's fair to say there's quite a wide spectrum of venues, some regulated, some less regulated, some not regulated, different part of the world, different continents. If you're an institution and you look at, you're the risk manager of a large bank or asset manager, and you want to get into crypto, and you ask your staff, how do I set up futures and options on crypto? It's got to be a bit of pushback in terms of how complex the picture is. Where do you go? And how can an institution get... Is the market going to provide a framework where it's easier for those institutions to come in? And does that mean they all have to be regulated? Do you see a move towards more regulated marketplaces?
So speaking for us, absolutely yes. I think there are... so in terms of being a large institution and entering the market, okay, what are your options? Either you are a large conservative institution, you're most likely going to trade through your existing prime broker, and when that prime broker offers you access to CME or to Eurex or to a Kraken, they're going to be worrying about all of the settlement and collateral on your behalf. Or you are a proprietary trading firm, more nimble and able to access these venues more directly. But certainly we've seen, for instance, Bybit as one example of a crypto-native exchange shut down entirely in places like France, Binance, very limited offering in Europe and the UK. And this is because the regulation is becoming very clear. In many cases it wasn't a surprise and not too dissimilar from what people would have expected to begin with. But yeah, I think the idea of a large institution trading on a crypto-native, unregulated venue domiciled in the Seychelles is not a plausible one.
Do we think it could go back to the US or go to the US at some point? We would have like a crypto derivative exchange in the US?
I think there's certainly optimism there right now. It'll be interesting to see if we start seeing some of the offshore US players trying to move toward getting regulation onshore. I think understanding how long regulatory process takes is not always top of mind for crypto. So I think these elements might take a little bit longer than expected to actually come to fruition. But I think ultimately we do have a very segmented market by region driven by regulatory restrictions. I think it will be some time to ultimately open that up.
I mean, just an observation. Is it fair to say that with the venue of the advent of the crypto, the BTC ETF option, could there be a best scenario where that basically creates a framework where risk management teams in the US, in US institutions, get familiar with how to price vol in crypto or credit in crypto, because it's a US regulated framework, and they learn from that to effectively get more comfortable to deploy capital in crypto within their existing kind of risk management frameworks. Is it some trend that you can see?
I think it's an interesting question. So in the US, you've had the CME futures and options now for a number of years. Economically speaking, it's not dissimilar in terms of the exposure you get with the ETF options, but it's a dramatically different client segment. And so in the US, generally speaking, retail investors or even high net worth individuals are not really trading futures and options on the CME, generally speaking, but they are trading ETF options in massive size. And so they bring that much more volume and liquidity to the market and make it that much easier for these folks to price the risk and understand the mechanics.
Cool. So, conscious of time, and before I ask the panelists to give some less thought, I just want to do a show of hands in the room. Who has been involved in crypto derivatives, futures or options, or want to be involved pretty soon? Okay, 33% of the room. That's a good ratio. So I just want to maybe now ask the panelists, where do they see the crypto derivative market in 5 years? Are we going to do 5x, 10x, like we've seen the jump for commodities, for instance, in the 2000s with the financialization of commodities? Are we going to really see the financialization of crypto within the next 5 years? And if yes, how and why?
I think the short answer is yes. I suspect that you'll see, much like the sort of trend in TradFi, the notional traded volume far exceed that of the spot markets. It's just a sort of a natural progression. I suspect that the products that will come over the next 1 to 2 years will largely drive further adoption of derivatives. As an example, I think we had something like 40 ETF applications in the US just in the month of January. So I suspect that you'll see a lot of new products that will then require, or at least desire, to have a derivative on top of that. A Solana ETF would naturally want to have some sort of future that could be traded against it. These are the things that drive institutional adoption and ultimately, allow large RIAs, wealth managers, banks to start to sell these things to clients as structured products or income products.
I agree. I think this market's only going to continue to grow, both as retail investors get more sophisticated and as more institutional investors come into the fray and need to effectively hedge their risk. I think the options market right now is sort of ripe for the taking. There are a lot of exchanges, some of whom we've worked with directly, looking to chip market share away from Deribit. And I think that will continue to be an area where institutions will feel more comfortable from a counterparty risk perspective with more venues to trade on. So that's an area that we definitely see growth in.
I agree with everything that's been said. Derivatives will definitely continue to grow at a pace faster than the underlying spot market. I think one thing that's will be interesting to see is to what extent these centrally cleared, regulated avenues can coexist with any sort of direct market access for individuals, which philosophically we hope to be the case, but that'll be the interesting thing to see over the next 5 years.
Great. My view would be, my wish would be that we prove Warren Buffett wrong, that derivatives are not instruments of mass destruction, but they're going to be for crypto instruments of mass adoption. Thank you very much.
Thank you.